Pose with the fans. Pose with the pose with the pose with the fans. Pose with the pose with the pose with the fans. Pose with the fans. Pose with the fans. Pose with the fans. Pose with the pose with the pose with the fans. Pose with the pose with the pose with the fans. Pose with the fans. Pose with the
I need to start a small business, but I don't have enough money. It's so confusing.
That's what companies begin too. When they don't have money to grow, they go to capital market.
Capital market?
Yes, it's like a marketplace where a business raises money, not by borrowing from another person, but by issuing shares or bonds to investors who want to grow their money.
So, who's involved in the process?
A lot of people are involved in the primary market. First, there are corporations which sell shares or bonds to raise money. Then, there are banks which help organize the sale, set the price, and connect the company to potential investors.
Institutions such as insurance companies or investment funds also play a role by purchasing large amounts of the securities.
Lastly, a public accounting firm checks the company's financial records to ensure that everything is accurate and fair for investors.
Capital market is a place where entities such as individuals, businesses, or companies can invest or borrow money for long-term use.
During the prelim period, we learned why capital markets are important. They help businesses get the money they need to grow, allow people to invest and earn, support the overall growth of the economy, and make it easier to buy and sell investments when needed. We also learned that the capital market has two parts. The primary market, where new investments like stocks are sold to the public for the first time. There are few key players in the primary markets, namely corporations, banks, institutions, investors, and public accounting firms. Corporations issue bonds or shares to get funds for expansion, operations, or other purposes. They require capital to run their operation. Banks acts as an intermediaries or underwriters. They help corporates connect with investors. This is why they are called the sell side. They help sell the newly issued securities to the market. They have contacts with both corporates and institutions. Institutions consist of three investors: fund manager, institutional investors, and retail investors. They represent the buy side because they purchase the securities to invest and provide capital to corporation. Public accounting firms analyze financial reporting, handle taxes, conduct audits, and provide consultation services to ensure transparency and accuracy in a company's financial activities. There are three main types of public issues in the primary market. First is a public issue, which includes an initial public offering, when an unlisted company offers new securities to the public for the first time. It also includes a follow-on public offer, where an already listed company issues additional securities to the public. The second type is a rights issue, where a company raises additional capital by offering existing shareholders the right to buy new shares or debentures in proportion to their current holdings. The third type is a private placement, which involves issuing securities, either debt or equity, to a limited group of investors such as banks, financial institutions, mutual funds, or high net worth individuals. This process is usually facilitated by a merchant or investment banker who acts as an agent between the issuer and the investors. Also, there are participants involved in issue of shares in primary market, merchant banker, underwriter, draft prospectus, book building, demat issues, brokers and banks, registrar and transfer agents. The secondary market is a place where existing securities are traded. Fund managers represent the participants who either want to sell or buy securities. Investment banks assist both sellers and buyers through services such as sales, trading, and research. These transactions occur through a centralized marketplace like a stock exchange or over-the-counter market. Investment banks help connect sellers and buyers, making it easier to adjust their holdings based on risk and return. This process provides investors with liquidity and the ability to manage their investments more effectively. We also get to know the participants in the capital markets, such as investment banks, stock exchange, traders, brokers, corporations, clearing agencies, investors, banks, financial institutions. In the midterm lessons, we study the securities such as stocks, bonds, and derivatives. Stocks, which mean you own a part of a company, while bonds is a debt instrument. Derivatives, which are special contracts based on other investments and plays an important role in financial market. We also learn the characteristics and valuations of stocks, including earnings per share, price to earning ratio, dividend yield, market capitalization, growth potential, debt level, profitability and margins, management and corporate governance. Additionally, the type of bonds are treasury notes and bonds, corporate bonds, municipal bonds, and mortgage securities. In the pre-final lessons, we focus on how markets work and how buying and selling happen. Market structure refers to how a market is organized. It shows how buyers and sellers interact, how prices are set, and how much competition exists. Different markets follow a different structures, each with its own traits. Perfect competition happens when there are many sellers offering the same product. No one controls the price because the products are identical. Think of a fruit stand or a fish market.
Monopoly is when only one seller exists. They control the entire supply and can set prices freely. This limits consumer choice and usually leads to higher prices. Examples include local water or electricity providers. On the other hand, oligopoly is a market where only a few large firms dominate. These companies can influence price and may even coordinate strategies. Examples include the airline industry or mobile networks. Monopolistic competition involves many sellers, but their products are slightly different. Branding and advertising help them stand out. The restaurant industry is a good example of this setup. Duopoly is when two major firms control most of the market. They compete closely and each one's moves affects the other. PLDT and Globe in telecommunications are an example. Now, let's talk about trading mechanism. It is how financial products like stocks, bonds, or currencies are bought and sold. Auction markets work through bidding. Buyers place bids and the highest bidder gets the asset. Dealer markets use intermediaries called dealers. They buy and sell from their own inventory. Buyers don't interact directly. They trade with the dealer instead. Electronic communication networks are digital platforms that match buyers and sellers directly with no middlemen. This makes trades fast and efficient. Dark pools are private trading venues where large investors trade big volumes anonymously. They do this to avoid affecting market prices. Hybrid markets combine features of auction and dealer systems. They offer both traditional and electronic ways to trade. Some systems trade all day called continuous markets, while others use periodic auctions where trading happens at a specific times only. Let's move on to stock exchanges, where people buy and sell stocks. A stock exchange is a formal marketplace that helps companies raise money by selling shares. It also helps investors buy and sell securities. In the Philippines, we have the Philippine Stock Exchange for stocks and the Philippine Dealing and Exchange Corporation for bonds. These platforms are regulated, provide transparency, and support fair pricing. Stock exchanges help companies grow by giving them access to capital. In return, investors get opportunities to earn returns on their money. Moreover, over-the-counter markets are decentralized platforms that allow people to trade directly with each other rather than through formal exchanges. They offer more flexibility but are less transparent and are commonly used for trading bonds, derivatives, and foreign currencies. However, they also come with higher counterparty risk. Next, let's talk about auction systems. Auctions are used to sell goods or assets by letting people bid. There are different types of auctions. First is the English auctions. Bids go up and the highest wins. Next is the Dutch auction. It starts high and lowers the price until someone buys. Next is the sealed bid auctions. Everyone submits secret bids and the highest wins. Lastly, the Victory auction. Highest bidder wins but only pays the second highest price. Auctions are widely used in government asset sales, online platforms, or real estate. Finally, we have clearing and settlement, the process that happens after a trade is made. Clearing confirms trade details, matches buyers and sellers, and makes sure everything is in order. This is done by a clearinghouse, which reduces the risk of one party not fulfilling their promise. Settlement is when the actual exchange of money and securities takes place. In the Philippines, settlement is done on a T+2 basis, which means 2 days after the trade. Entities like the Philippine Depository and Trust Corporation handle these transactions. The goal is to ensure secure, efficient, and timely transfer of ownership. Understanding market structures and trading mechanisms help us see how the financial system works, from how prices are set to how assets are traded. Each part plays a role in keeping the market flowing smoothly.
We are planning to sell new equity shares next quarter to raise capital for expansion. We want to price each share at 15 pesos each to reach our target of 3 billion pesos. We expect your full support.
We understand your plans, but the valuation seems overestimated. If 2 pesos is too high, we think it should be 12 pesos. If not, then we won't invest.
Let's not escalate things here. We're here to facilitate a smooth issuance.
Perhaps we can assist the financial without help of accounting firms.
We'll conduct an updated valuation to ensure transparency.
What should banks do when the companies and investors don't agree in the share pricing during capital raising?
Based on demand, a fair price will be between 13 and 14.50 per share.
Fine, that's acceptable. We will cooperate.
If the reassessment proves solid, we're open to renegotiating our commitment. We can work with that.
With the bank's guidance and accounting firm's objectivity, both parties agreed to move forward based on BS systems. Conflict resolved.
So, good afternoon, everyone. Thank you for attending this meeting. And so, as you all know, our company called Some of Our Bonds. This was done to better manage our financial obligations.
Ms. Tinggal, while you may understand your position, we will pass a concern. Callable bonds led corporation to purchase bonds early, giving us a disadvantage. We expected longer returns. It's calculated, unpredictable callable bonds affects your investment plans. We'd like to discuss another options like using non-callable bonds to protect our interests.
I understand your concerns, but callable bonds give the company the flexibility to handle its finances. It's a common approach in the capital market.
What costs? Callable bonds might help the issuer, but can put our financial security at risk. We need more stability and assurance.
We suggest the company consider issuing non-callable or limit the callable feature to a certain condition to ensure fairness. That really sounds reasonable. However, from a corporation's perspective, callable bonds help lower interest costs when market conditions change.
From a bondholder's perspective, it is feels like an unfair advantage. We are simply asking for more transparency and protection.
As the discussion continues, each bondholder takes a moment to share their specific concerns and experience with callable bonds.
I invested heavily with expectations of long-term stability. Suddenly, having my bonds reduced due to declining interest rate disrupt my financial planning.
For me, it's all about consistency. Callable bonds make it hard to predict returns. As an investor, predictability is important for effective planning.
We are not saying that callable bonds should be removed entirely, but there should be a safeguard or a stricter condition before they can be used.
Callable bonds seems to favor the company without considering the investor size. We need more balanced structure.
I agree. While callable bonds have their advantages, offering non-callable bonds would attract investors looking for more security.
I hear your concerns, and I think we can find a compromise. Perhaps the corporation can offer both callable and non-callable bonds, with a higher interest rates for the non-callable ones to offer more predictability.
It's reassuring to me that there will be a compromise long we have choice give us confidence in our Agree. Having a choice between callable and non-callable bonds provides flexibility for the both issuers and the investors.
And ensures that we, as an investors, we are not caught on guard for a sudden cost.
This approach could be a win-win. The company maintains flexibility and gain more predictability and security.
Don't worry. We will make sure to clearly outline the terms and communicate them to you effectively. Thank you all for your input. Meeting adjourned.
With the banks help immediately and the corporation's willingness to compromise, both the issuer and bondholder reach a fair agreement. By offering both callable and non-callable with clear terms, both issues were addressed, conflict resolved. In the world of capital markets, nothing is ever truly final. Just when an agreement seems secure, new opportunities can arise, shifting decisions in an instant. This reminds us that the market is constantly changing and investors must stay alert, adaptable, and strategic. Loyalty is important, but in finance decisions, it often allows where the value and security are strongest. That's the reality of competition and the challenge of making lasting deals.
Beyond foundational concepts, our lessons explored the specific processes and participants involved in the issuance of securities in the primary market. We learned about the roles of merchant bankers who prepare the draft prospectus and advise in the size and pricing of share issues. Underwriters also play an important role by helping determine the offering price and facilitating the distribution of securities. We
We studied the Philippine Stock Exchange Index, which serves as the main benchmark for the Philippine stock market. It reflects the overall performance and the sentiment of the country's largest and most actively traded companies. This gives the investors a broad view of how the economy and major businesses are performing.
We also learn about key valuation metrics used to analyze stocks. Earnings per share measures a company's profitability by dividing net income by the number of outstanding shares. The price-to-earnings ratio compares a company's stock price to its EPS to help assess value.
Another important metric we discussed is dividend yield, which shows the percentage returns from dividend relative to the stock price. This is useful for income-focused investors. We also explored market capitalization, which is calculated by multiplying the stock price by the total number of outstanding shares.
Market capitalization indicates a company's size and stability. Large-cap companies are generally more stable but may have lower growth potential than smaller firms. Other factors considered in stock valuation include a company's growth potential, debt levels, and profitability margins.
We understood that companies with strong growth prospects, manageable debt, and healthy profit margins are usually valued higher. Good corporate governance and effective management also lead to better long-term performance and help build investor confidence.
We also learn about the benefits of listing shares on a stock exchange. These include increased visibility, enhanced financial standing, easier access to capital, improved liquidity for shareholders, and greater public awareness. Employee share options also become more visible for listed companies.
In terms of bond types, we studied treasury notes and bonds, corporate bonds and municipal bonds. Municipal bonds including general obligation bonds and revenue bonds. Industrial development bonds, a type of revenue bonds, help fund projects like factories. Corporate bonds can be secured or unsecured.
Lastly, we discussed the evolution and structure of the Philippine capital market. Reforms like liberalization, privatization, and the introduction of ADRs and country funds have attracted foreign investment. We also learned about different market structures and trading venues like centralized exchanges and OTC markets, deepening our understanding of how capital markets function.
In the ever-changing world of capital markets, staying informed and adaptable is key.
The knowledge we have gained has prepared us to understand and face the real-life world's financial decisions.
As future professionals,
We carry these lessons forward.
Ready to grow?
invest,
And lead responsibly.
because in every transaction, trust and strategy matters.
Help the organization learn about the benefits of listing shares.
Understand.
Corporations to raise money. But the company. Wow!